Welcome to the fundamental truth of modern finance. Complexity is often the enemy of ownership. Today, we introduce the wealth mirror test. It's starkly simple. If you cannot describe what you own, how it generates returns, and why it's in your portfolio using only 3 clear, concise sentences, then you do not actually own that investment. It owns you. Think about that for a moment. If a 10-year-old asked you to explain your most expensive asset, could you do it without resorting to jargon or vague promises of high growth? The wealthy understand that true power lies in transparency and simplicity. The less you understand, the more power you concede to fees, hidden structures, and emotional panic during market turbulence. This test separates the knowledgeable owner from the hopeful speculator, defining the financial boundary between those who build lasting wealth and those who remain perpetually dependent on external advice or market luck. The primary difference between the financial architecture of the rich and the structure of the average portfolio is clarity. The rich prioritize assets they can manage, influence, or at least fully comprehend. Their strategy is often simple, repeatable, and fundamentally sound. They look for direct ownership stakes in real businesses, productive land, or vast pools of stable assets like broad market indices. Their 3 sentences are clear. This is a piece of a profitable business that generates free cash flow. We reinvest the profits to expand its market share. I own it because its long-term viability is independent of short-term economic fluctuations. This transparency enables strategic, long-term decision-making, removing the need for constant, anxious monitoring. Simplicity isn't a lack of sophistication. It's the highest form of financial discipline, ensuring every component of their wealth is actively working for them, not confusing them.
Conversely, the middle class is often drawn into complexity, equating it with exclusivity or guaranteed high returns. They are susceptible to products layered with obscure derivatives, structured notes, or illiquid alternative funds, often sold by advisors who profit directly from that complexity. When tested, their response is vague. It's a special fund that hedges against inflation and uses leverage for amplified growth. They rely on buzzwords like alpha and proprietary strategies because they lack the foundational understanding to critique the mechanics. This fascination with complexity leaves them financially vulnerable. If you cannot explain the mechanism of return, you cannot evaluate the risk, and you certainly cannot determine if the fees are justified. The very nature of the complexity means you must outsource your thinking, giving up the most crucial aspect of wealth accumulation: control.
Let's look at a concrete example: the speculator who chases hype. They bought a volatile cryptocurrency or a meme stock based on a sudden social media narrative. When applying the wealth mirror test, their 3 sentences fail immediately. They might say, "It's going to the moon, everyone is talking about it, and I'll sell when I double my money." Notice that none of those sentences describe the asset's intrinsic value, revenue generation, or market position. They describe emotion, speculation, and herd mentality. This investment doesn't operate under their ownership. It dictates their actions. They are forced to check their phone constantly, follow online rumors, and make snap decisions driven by fear of missing out, FOMO, or fear of loss. The asset owns the speculator's mental real estate and their time, transforming potential wealth creation into a high-stakes, stressful gamble. Another common trap is the highly compensated but opaque financial product. Consider annuities or certain private equity funds offered to retail investors. While legitimate instruments exist, many are structured specifically to be difficult to understand. If your 3 sentences must include terms like surrender period, mortality expense ratio, or hurdle rate, you are likely dealing with a product where the complexity serves to justify the high fees and mask potential illiquidity. These products often lock up your capital for years, severely limiting your financial agility. The moment you cannot explain the exit strategy, the tax implications, or the underlying mechanics of how the administrator profits, you have ceded control. You are no longer the investment manager. You are the source of guaranteed revenue for the product provider, proving the asset firmly owns you. The 3-sentence rule is designed to force clarity. Here is how the framework should look, regardless of the asset class. Sentence 1 must define the asset. What is it? Is it corporate debt, fractional ownership of a business, or an apartment building? Sentence 2 must describe the income mechanism. How does it make money? Does it pay rent, collect interest, or grow revenue through sales?
Sentence 3 must justify the ownership. Why do I own it? Is it for diversification, stable income, or long-term capital appreciation? If you find yourself struggling to articulate any of these 3 points without getting lost in specialized details, it is a glaring red flag. Simplify the structure until the narrative is solid. If simplification is impossible, you must liquidate the asset because its primary function is confusion, not wealth creation.
Let's examine how the wealthy approach real assets using the 3-sentence rule. Take commercial real estate, a cornerstone of many successful portfolios. The explanation is inherently simple. I own an industrial warehouse facility and a growing logistics hub. It generates profit through long-term leases paid by established corporations. I hold it for stable, inflation-adjusted cash flow and land appreciation. This description is tangible, verifiable, and predictive. The owner understands exactly where the money comes from, the rent, and why the value increases, demand for logistics space. This transparency allows the owner to be proactive. They can renegotiate leases, conduct necessary repairs, or leverage the asset strategically. They are not waiting for a quarterly report to explain a mysterious drop in valuation. They are in command of the factors driving performance. Even when investing passively in the stock market, the rich prioritize understanding the underlying mechanism. Consider the broad-based, low-cost index fund. While it is diversified, the explanation remains powerfully simple. This fund holds a tiny fractional share of the 500 largest publicly traded companies in America. It makes money as those companies collectively earn profits, grow, and pay dividends, minus a minuscule fee. I own it because it captures the entire growth of the U.S. economy, offering maximum diversification and historical risk-adjusted returns. This clarity is liberating. The owner knows they don't need to pick winners. They own the ecosystem of winners. They aren't owned by the index fund. They are harnessing the combined power of capital markets, allowing them to remain disciplined and ignore the daily noise that paralyzes the uninformed investor. The cost of not being able to pass the wealth mirror test is enormous, extending far beyond measurable fees. It's the cost of paralysis. When markets inevitably crash, the owner who understands their assets sees opportunity or necessary stability. The speculator who doesn't understand their assets experiences blinding fear. They sell low because they cannot articulate why they bought in the first place, or they panic and liquidate high-quality assets they mistook for complicated risks. Furthermore, ignorance makes you a perpetual target for high-fee salesmanship. If you don't know that paying 1% more in fees can slash your potential retirement wealth by 20%.
It's time for a personal audit. Apply the wealth mirror test to your entire portfolio tonight. Pull up your brokerage statement and choose the 3 largest holdings you possess. Can you describe each of them accurately using 3 sentences? Write them down. If the description is vague, requires looking up technical terms, or sounds like a sales pitch, you have work to do. This audit forces accountability. If you cannot explain an asset to your family, you shouldn't be trusting your family's future to it. Begin the process of simplifying. For any asset that fails the test, schedule a dedicated hour to research its core mechanics. If after deep research you still cannot simplify it into those 3 sentences, it is a clear signal that the asset is designed for someone else's profit, not yours. Don't delay this critical step.
The ultimate goal of passing the wealth mirror test is not just knowing details, but achieving financial agency. This shift is philosophical, moving from being a passive recipient of financial products to becoming an active principal, directing capital intelligently. When you own your investments through deep understanding, you are in control of the timeline, the risk profile, and the expected returns. You move from saying, "I hope this works out," to "I understand why this will work out." This foundation of knowledge eliminates emotional volatility and instills the patience required for genuine, long-term wealth compounding. True ownership means that if the entire financial world collapsed tomorrow, you would still be able to rebuild because you possess the knowledge, not just the fleeting assets.
The wealth mirror test offers a permanent filter for your portfolio, a defense against the complexity trap that ensnares so many investors. Remember the rule: clarity equals control. If you cannot describe it in 3 sentences, you don't own it. It owns you, dictating your fear, consuming your time, and draining your wealth through obscurity.
Take back your financial power by demanding radical simplicity and complete transparency from every dollar you invest. Let knowledge, not hope, be the engine of your success, allowing you to focus on the things that truly matter while your clear, concise portfolio silently compounds. Apply the test today. Don't forget to like and subscribe for more updates on building a foundation of financial intelligence and lasting independence.